February 8th, 2016. 8:47 a.m., San Francisco. Parker Conrad sits in a conference room at Zenefits headquarters. Outside the door, 1,600 employees wait. Inside, board members from Fidelity and Andreessen Horowitz deliver an ultimatum. Resign. Today, or we fire you and sue. Conrad built Zenefits in 3 years, 0 to 1,600 employees, 0 to $4.5 billion valuation. Fastest growing software company in history. Now, collapsing in real time. Now, here's what nobody understood until too late. Zenefits wasn't just selling HR software. They were selling insurance, health insurance, life insurance, benefits for millions of American workers. But here's the problem. The people selling it, half didn't have licenses, illegal in all 50 states. How did a company worth $4.5 billion, backed by Silicon Valley's smartest investors, break federal law for 3 years? Who knew? Who didn't care? And why did insurance regulators across America miss it? This is Zenefits. This is what happens when move fast and break things meets industries built on trust. But this isn't just about Silicon Valley excess. If you have health insurance through your employer, life insurance coverage, any workplace benefits, this matters. Because unlicensed people selling insurance creates real dangers. Wrong coverage, gaps in policies, claims denied, problems discovered years later when you need coverage most. $980,000 in fines. But millions of workers got insurance from people who never passed required tests. Let me show you how a company everyone praised was breaking laws nobody checked. But first, understand the pattern. This isn't the first tech company to decide rules don't apply, won't be the last. There's a pattern that repeats whenever startups prioritize growth over compliance. Stage 1, the shortcut. Find regulatory loophole or ignore requirement entirely. Stage 2, the rationalization. Convince yourself rules are outdated, don't apply, or can fix later. Stage 3, the acceleration. Grow so fast, nobody notices or checks. Stage 4, the exposure. Whistleblower, regulator, or journalist discovers truth. Stage 5, the reckoning. Fines, resignations, settlements, reforms. Uber followed this. Ignored taxi regulations. Built $70 billion company. Paid billions in fines and settlements. Theranos followed this. Faked medical tests. Raised $700 million, founder convicted. Sentenced to 11 years. Airbnb followed this. Ignored hotel laws. Built a $100 billion company. Now paying hotel taxes retroactively. Same pattern. Different industry. Same result. In 2013, Zenefits entered stage 1. By 2016, stage 5. Let me show you how Silicon Valley's golden child became a cautionary tale about what happens when you break rules millions of people depend on. First, understand what Zenefits was supposed to be. If you remember the days when workplace benefits meant filling out forms by hand, carbon copies, filing cabinets, waiting weeks, Zenefits promised to fix all that. One software platform, health insurance, payroll, time off, benefits, all automated. For small businesses, revolutionary, no HR department needed, everything online, save thousands. And here's the genius part. Zenefits gave the software away free, completely free. How did they make money? Insurance commissions. When small business signed up for Zenefits software, Zenefits helped them buy health insurance for employees. Every policy sold, insurance companies paid Zenefits a commission. Industry standard, 3 to 6% of annual premiums. Think of Zenefits like a combination insurance broker and HR department. Broker part made money, software part attracted customers. Perfectly legal business model. Insurance companies do this every day. But here's the catch. The law that's existed for decades. To sell insurance in America, health, life, disability, any kind, you need a license, not optional. Federal requirement. Every state enforces it. Why? Because insurance is complicated. People's health, lives, families depend on getting coverage right. Wrong policy? Medical bills not covered, claims denied, families bankrupt. So insurance licenses require education, classes, tests, background checks. Continuing education takes time, costs money, exists for good reason. If you bought health insurance in the last 50 years, person who sold it had a license. Guaranteed. System works. Now meet Parker Conrad, born 1980. Grew up in San Francisco, Stanford graduate, computer science background. First startup failed. Second startup, payroll company sold for modest sum. 2013, age 33, Conrad starts Zenefits. His insight? Small businesses hate dealing with benefits. Too complicated, too expensive, too much paperwork. His solution? Automate everything. Make it free, grow fast. Silicon Valley loved it. By 2014, Zenefits raising money at $500 million valuation. By 2015, $4.5 billion, Andreessen Horowitz. Fidelity. institutional venture partners, best investors in technology. Growing faster than Facebook, faster than Google, fastest software company ever. Adding 100 plus employees per month, hiring salespeople as fast as possible, young, energetic, commission-based, sell more, earn more. Company culture? Move fast, break records. Don't ask permission. Move fast and break things. Mark Zuckerberg's famous motto. Zenefits took it seriously. But here's what investors didn't ask, what Conrad didn't tell them, what employees didn't question. Those hundreds of salespeople selling insurance, half didn't have licenses, not because they were waiting for approval, not because licenses delayed, because Zenefits didn't care. The fatal flaw? Conrad decided licensing laws were inconvenient, slowed growth, made hiring harder, so he built a workaround. Insurance licensing requires completing online education courses, hours of classes, then pass state exam. Time-consuming? Yes, that's the point. Supposed to ensure competency. Conrad's solution? He had Zenefits engineers build software that let employees cheat, called it the Macro, special program that automatically clicked through training courses. Completed 8-hour course in 15 minutes. No learning, no testing, just automated clicking. Employees would start the Macro, go to lunch, come back, course complete. Then they'd take licensing exam. Many failed, multiple times, because they hadn't actually learned anything. But Zenefits kept them selling anyway, unlicensed, because growth mattered more than laws. This matters if you bought insurance in those years, because the person who sold your policy might have no idea what they were selling. Think about that. Your health insurance, your family's coverage, sold by someone who automated their education and failed their licensing test. System exists for a reason. Conrad decided reason didn't apply to him. Why? Because he could. This was 2013-2015. Tech boom at peak. Investors throwing money at startups. Regulators overwhelmed. Disruption celebrated. Nobody checking. Nobody asking questions. Until somebody did. Part 1. First temptation. Summer 2013. Zenefits 6 months old. Conrad faces a problem. Good problem, but problem nonetheless. Zenefits growing faster than expected. Businesses signing up. Employees joining. Everything working. Except one thing. Getting salespeople licensed takes too long. California requires 52 hours of pre-licensing education. Then pass state exam. Background check. Entire process. 6 to 8 weeks. For traditional insurance companies, fine. They hire slowly, train properly. But Conrad promised investors exponential growth, doubling every quarter, tripling revenue. Can't wait 8 weeks per salesperson, kills momentum. So Conrad makes a decision. Let them sell while waiting for licenses, just temporarily, until process completes. Technically illegal. But he tells himself, they're in process. Applications submitted. Just bridging gap. Rationalization begins. This is the moment. The choice that determines everything after. Conrad could have hired faster to account for licensing delays, slowed growth temporarily, partnered with licensed brokers, followed the law. He chose speed. Because in Silicon Valley, 2013, speed was everything. First company to scale won. Second place meant nothing. VCs told him, move faster, grow bigger, worry about compliance later. Later never came. Part 2, escalation. By late 2013, temporary unlicensed selling became permanent practice. But Conrad went further. He ordered engineers to build the Macro, the automated training software. Why? Because legitimate training took too long. Employees complained, wanted to start selling immediately. Macro solved that. Finished training in one afternoon. Start selling next day. Engineering team uncomfortable. This was clearly cheating. Clearly illegal. Conrad's response? We're disrupting an outdated industry. Rules need to change. Classic stage 2, rationalization. Deal 1, fall 2013. Major California business signs up. 50 employees need health insurance. Zenefits salesperson, unlicensed, sells them coverage. $180,000 in premiums. Zenefits earns $2,800 commission. Policy has gaps, wrong coverage levels. Business doesn't notice until an employee has major medical bill 18 months later. Claim partially denied. Deal 2, spring 2014, Florida. Zenefits expands. Hiring salespeople rapidly. Training? Macro program. 3 hours total. Salespeople don't understand policy differences. Don't know Florida insurance law. Sell anyway. One sells disability insurance with wrong elimination period. Client becomes disabled. Discovers gap means no coverage for first 6 months. By then, financial damage done. Deal 3, fall 2014, Texas. Zenefits now in 43 states. Compliance team raises concerns. Many states flagging unlicensed activity. Conrad's response? Fire compliance team members who complain. Hire new ones who stay quiet. This is stage 2. Escalation, fearless. Company culture shifts. Employees who question compliance policies marginalized. Employees who hit sales targets promoted. Message clear. Growth matters. Rules don't. Remember, we're in stage 2 of 5, pattern accelerating. Part 3, warnings ignored. But people noticed. 2014, Washington State Insurance Regulator receives complaint. Zenefits salesperson unlicensed. Regulator investigates. Finds multiple Zenefits employees selling without licenses. Sends warning letter. Demands compliance. Conrad's response? Lawyer up. Argue technicalities. Delay. Meanwhile, continues expanding to more states. Arizona, Virginia, Maryland, all with same unlicensed sales force. December 2014, Zenefits raises $500 million at $4.5 billion valuation. Investors include Fidelity, institutional investors, pension funds, money managing retirement savings for millions. Due diligence process. Did they ask about licensing compliance? If they did, Conrad lied or deflected. If they didn't, they failed basic oversight. Either way, $4.5 billion valuation built on systematic lawbreaking. Internal compliance officer, hired 2014, sends email to Conrad. Subject line, licensing crisis. Details, over 400 employees selling insurance without licenses, multiple state violations, potential federal investigation. Recommends, stop all unlicensed sales immediately, implement proper training, fix compliance systems. Conrad's response, email reply, thanks for feedback. We'll address when we have bandwidth. Translation, ignore it. Compliance officer quits 3 months later. This was last chance to stop it. December 2014. Instead, Conrad doubled down, hired more salespeople, expanded to more states, accelerated growth. Let's do the math on Zenefits growth. 2013 revenue, $1 million 2014 revenue, $20 million 2015 revenue, $100 million growth rate, 100x in 2 years. How? Licensed salespeople can close 3 to 5 deals per month, proper training, understand products. Unlicensed salespeople closing 8 to 12 deals per month, no training time, faster starts, ignore complexity. Time saved per employee, 6 to 8 weeks licensing process. 400 unlicensed employees, x 8 weeks, saved. Jamesker 3,200 weeks. Stargrim 61 years of productivity gained. That's how they grew 100x, by breaking law. Numbers don't lie. If you had health insurance from small business 2014, 2015, check who brokered it. Might have been Zenefits, might have been unlicensed person. Part 1, the system. By 2015, Zenefits wasn't a startup. It was a machine. 600 employees. Offices in 8 cities, processing benefits for 20,000 companies, ensuring 200,000 American workers and families. Here's how the system worked. Step 1, business signs up for free HR software. Step 2, Zenefits salesperson calls, recommends insurance policies. Step 3, business agrees, thinking they're getting expert advice. Step 4, salesperson, often unlicensed, processes enrollment. Step 5, insurance company pays Zenefits commission. Simple, efficient, completely illegal in half the cases. But who checked? Insurance companies didn't verify if Zenefits employees licensed. Assumed reputable $4.5 billion company followed law. State regulators didn't have resources to investigate every broker, relied on spot checks and complaints. Businesses buying coverage didn't know to ask. Trusted Zenefits brand. System depended on trust. Zenefits exploited that trust. Here's what made it work. Insurance is state regulated, 50 different state systems, no centralized database. Zenefits operated in 47 states simultaneously. Even if one state investigated, others didn't know. Regulatory fragmentation enabled fraud. And Conrad kept hiring, because more salespeople meant more revenue, meant higher valuation. Hiring process, 23-year-olds straight out of college, no insurance experience, no financial background, just enthusiasm and willingness to work long hours. Training, the macro, 3 hours, then selling policies worth millions. Part 2, lifestyle. Meanwhile, Conrad living the Silicon Valley dream. Company parties legendary, open bars, catered meals, bonuses for top performers. Conrad himself, net worth on paper, over $1 billion, age 35. Forbes, 30 under 30, TechCrunch Disrupt winner. Speaking at conferences about disruption and innovation. Profile in Vanity Fair titled The Next Steve Jobs, but behind scenes, chaos. Employee turnover 40% annually, high pressure, impossible quotas, burnout and quit, sexual harassment complaints, partying culture, reports of employees drinking at desks during work hours. Tech press called it frat house culture. But Conrad didn't care. Growth covered all problems. Here's what he told investors in 2015. We're not just building a company, we're changing how America does benefits. Old rules don't apply. That last part was true. He wasn't following rules. Psychology of unlimited power. When you're worth $1 billion at age 35, when investors give you $500 million, when magazines call you the next Steve Jobs, you start believing you're special, different, above normal constraints. If you remember the 1980s excesses, Gordon Gekko, greed is good, junk bond kings, this was that with tech veneer. Same arrogance, same belief rules are for others. Well, let's do the math on commissions. Average small business, 25 employees. Average health insurance premium, $6,000 per employee per year. Total premiums, $150,000 Zenefits commission, 5%. $7,500 $1,000. Licensed salespeople selling 5 clients each, 5,000 clients, 37.5 million annual commissions. 400 unlicensed salespeople selling 8 clients each, 3,200 clients, or $24 million annual commissions. That $24 million illegally earned by unlicensed people selling policies to families who trusted them. Every dollar traced back to broken law. And investors, they wanted more. Part 1, first warnings. Late 2015, walls start closing. BuzzFeed News receives anonymous tip. Zenefits employees selling insurance without licenses. Reporter starts investigating, talks to former employees, reviews state licensing databases, finds dozens of Zenefits salespeople, no active licenses. December 2015, article publishes, Zenefits compliance problems run deeper than anyone knew. Details emerge, 400 plus unlicensed brokers, fake completion of mandatory training, state violations in dozens of states, internal emails showing Conrad knew public now knows. Stock market, if Zenefits were public, would have crashed, but private company. Investors trapped. Conrad's response? PR statement, isolated compliance issues, addressing immediately, committed to highest standards. Translation, caught, damage control mode. But he still thought he could survive. Part 2, pressure builds. Within weeks, dominoes fall. California insurance regulator launches formal investigation. Tennessee, Virginia, Georgia, Washington all announce investigations. Former employees, the compliance people Conrad ignored, start cooperating with regulators, providing documents, emails, evidence. Same emails Conrad thought were deleted. Compliance officer kept copies. One email from Conrad, October 2014. Don't worry about licensing, we'll fix later. Revenue matters now. Smoking gun. By January 2016, 50 state insurance departments investigating. Zenefits lawyers tell Conrad, criminal charges possible. Federal insurance fraud. RICO statute applies if systematic. Prison time. Real possibility. Investors panic. Company valued at $4.5 billion. If regulators shut them down, worth zero. Board demands meeting. Emergency session. Conrad's friends in venture capital, people who backed him, believed in him, now his adversaries. Because billions of their investors' money at risk, pension funds, endowments, regular people's retirement savings invested in Zenefits through fund managers, those people losing money because Conrad ignored laws. Part 3, final warning. February 7th, 2016, Sunday evening. Zenefits board member, partner at Andreessen Horowitz calls Conrad. Parker, you need to resign tomorrow. Board meeting 9 a.m. If you resign, we might save company. If you fight, company goes bankrupt and you face criminal charges. Conrad's response, we can fix this. I built this company. Board member, you broke the law systematically for 3 years, multiple states preparing charges. We have one option, remove you, show regulators we're serious about compliance. Maybe they don't shut us down. Conrad asks for time to think. Board member, you have until 9 a.m. If watching stocks or following business news in early 2016, warning signs were everywhere. Delayed financial statements, leadership changes, legal bills skyrocketing, classic red flags. But investors, including pension managers, already trapped. Too late to exit. Timeline urgency. By February 8th, walls completely closed. State charges, preparing. Federal investigation, ongoing. Board, unanimous. Conrad had 12 hours left as CEO. He didn't know it yet. Part 1, trigger, February 8th, 2016. 8:47 a.m. Conrad walks into conference room, expects normal board meeting. Instead, finds lawyer present. Resignation letter printed, already written. Board chairman speaks. Parker, we're removing you. You can resign now, leave with dignity, small severance, company survives. Or we fire you, public spectacle, lawsuits, company likely dies, Conrad argues. I built this company. We can fix compliance issues. Board member cuts him off. You knew, we have emails. You ordered the macro built. You ignored compliance officers. You lied to investors about licensing. It's over. Conrad realizes no negotiation, no second chance. At 9:15 a.m., signs resignation letter. By 10 a.m., email goes to all 1,600 employees. Founder and CEO has resigned, effective immediately. By 11 a.m., TechPress has story. TechCrunch headline, Zenefits CEO Parker Conrad resigns amid compliance crisis. By 2 p.m., state regulators issue statements. California, investigation continuing. Washington, violations confirmed. Tennessee, preparing enforcement action. By 5 p.m., Zenefits stock, on paper, worth 30% less. $4.5 billion to $3 billion one day. 35% value destroyed. Part 2, Cascade. Next 48 hours, Avalanche. February 9th, COO resigns. CFO resigns. General counsel resigns. February 10th, Zenefits announces hiring new CEO, David Sachs, PayPal veteran. First job, fix compliance disaster. February 11th, California Insurance Department announces $980,000 fine, the largest in state history for licensing violations. Washington State, $250,000 fine. Tennessee, $150,000 fine. Virginia, $100,000 fine. Total fines from multiple states over $1.5 million. But money wasn't worst part. Worst part, hundreds of businesses questioning their insurance coverage. Were policies valid, sold by unlicensed people? What if claims denied? Panic. Insurance companies reassure, policies valid, companies paying claims, not customers' fault. Zenefits broke law, but trust destroyed. Within month, 20% of Zenefits clients leave, switch to competitors, take their business elsewhere. Revenue drops. Company bleeding money. New CEO announces layoffs, 250 employees, then 300 more, from 1,600 to 1,050 in 3 months. Part 3, human cost. Meet Sarah Chen. Age 27, joined a Zenefits sales team 2014, used the macro, passed no tests, sold insurance for 18 months, total policies sold, $4.5 million in premiums. When scandal broke, Sarah fired. Can't get licensed now. State flags her application. History of circumventing training. Insurance career over at 27. Sarah's story repeated hundreds of times. Young salespeople who trusted Conrad, followed his orders, now can't work in insurance ever. And Conrad? He walked away with millions. His remaining Zenefits stock still worth $150 and $200 million after scandal. Employees? Unemployment checks? If this sounds familiar, because you remember 2008 when executives responsible for financial crisis walked away. Rich while employees lost jobs and retirement savings. Pattern identical. People who cause problems, rich enough to survive. People who follow orders, unemployed and blacklisted. Let's count final damage. Direct fines 1.5, total immediate impact $1.56 billion. Plus 550 employees laid off, 400 salespeople. Career damage, 20,000 businesses questioning coverage, 200,000 workers and families uncertain about insurance. One CEO's decision to ignore laws. $1.5 billion damage, 750 careers affected, 200,000 people's insurance questioned. Perspective, more than GDP of some small countries. Enough to fund health insurance for 150,000 people for 1 year. Equal to lifetime earnings of 1,500 average American workers. One man, 3 years. That much damage. Part 4. Raids, arrests. But here's surprising part. Parker Conrad? Never charged criminally. No arrest, no trial, no prison. Why? Because insurance licensing violations usually civil matters. Fines, not prison. And Conrad technically didn't sell insurance himself. Employees did. He just created system enabling it. Legal gray area. So Conrad walked, paid no personal fines, kept most of his money. Justice? Depends on definition. Part 1. Legal outcomes. What happened legally? Zenefits settled with California, $980,000 fine. Terms: admit wrongdoing, implement compliance systems. Third-party monitoring for 3 years. Regular audits. No unlicensed selling ever again. Washington State, $250,000 settlement. Similar terms. Tennessee, Virginia, Arizona, Massachusetts, all settled. Total, $1.5 million in fines. Federal investigation. SEC looked at whether Zenefits misled investors. Conrad interviewed, provided documents. Ultimately, no federal charges. Not enough evidence to prove criminal intent to defraud investors. Civil matter? Settled. Part 2. Others. What about employees who use the macro? Most face no consequences. Too many to prosecute individually. But state licensing boards flagged their records. Future licensing applications difficult. Some states banned them from applying for licenses for 5 years. Career impact, significant, can't work in insurance. Background checks show Zenefits employment. Employers avoid. What about executives who knew? COO, CFO, general counsel, all resigned. No criminal charges, no civil penalties. They moved to other companies, other roles. Career impact minimal. Part 3. Bailout to Austrian cleanup. Unlike bank bailouts. 2008, no taxpayer money bailed out Zenefits, private company. Private investors absorbed losses, but cleanup still required. New CEO David Sachs spent $50 million on compliance systems, real training programs, licensing verification, state-by-state compliance teams, legal department expansion. Third-party audits cost more than all fines combined. Jobs affected, 550 employees laid off. Not just sales, engineering, marketing, operations. Families impacted, people relocating to San Francisco for dream tech job, now unemployed in expensive city. Many couldn't afford to stay, left Bay Area, careers derailed. If sounds familiar, because you remember 2008 bailouts, pattern same. People who caused crisis, Parker Conrad, kept 150, $200 million. People who paid 550 employees unemployed, 400 salespeople career damaged. Workers who did nothing wrong bore consequences. Part 4. Where now? Where are they now? Parker Conrad. Started new company, Rippling, 2016. HR software, same space. Different approach. Compliance first, licensed properly, no shortcuts. Company successful. Raised $1.5 billion, valued at $13 billion as of 2024. Conrad rehabilitated, back on top. Zenefits still exists under new management. Revenue recovered, company smaller but stable. Still an HR software business, still competitive, but brand damaged. Lost trust hard to rebuild. Former employees, scattered. Some in tech, some left industry, few still in insurance. The 200,000 workers whose insurance sold by unlicensed people, they likely never knew. Policies valid, claims paid, no direct harm visible. But system harm? Trust in insurance brokers damaged. Questions about whether compliance matters. So what does Zenefits teach? Not just about one company, about tech culture, regulatory systems, and why licensing requirements exist for your protection. 3 lessons matter. Lesson 1, disruption. Can't ignore safety laws. Silicon Valley loves disruption. Breaking old industry rules, moving fast. Works great for software. Photo sharing, disrupt away. Social media, innovate freely. But insurance isn't social media. Insurance protects your health, life, family. When things go wrong, cancer diagnosis, disability, death, insurance means difference between financial survival and bankruptcy. That's why licensing exists, not bureaucracy, protection. Zenefits treated licensing like software terms of service, inconvenient text to click through. But insurance licenses require education because policies are complex. Wrong coverage levels, claim denied, wrong beneficiary, money goes to wrong person. Wrong elimination period on disability, no coverage when you need it most. Most Americans buy insurance 2 to 3 times in lives. Major decisions. Once for health coverage, once for life insurance. Maybe once for disability. Salesperson selling you that policy should know what they're doing. Historical comparison. Remember 2008 mortgage crisis? Loan officers selling mortgages without proper training. Didn't understand products. Sold people loans they couldn't afford. Result? Foreclosure crisis. Millions lost homes. Financial system nearly collapsed. Zenefits followed same pattern. Unlicensed people selling products they didn't understand. If you have employer benefits, pension investments, or retirement accounts, watch for benefits. Brokers who seem too young or inexperienced. Quick sales pitches without detailed explanations, pressure to sign immediately, reluctance to show credentials. Check if broker licensed. Every state has online database. Takes 30 seconds. Trust earned through competency, not disruption. Lesson 2. Investors don't always do due diligence. Zenefits raised $500 million from Fidelity. Andreessen Horowitz, institutional venture partners, best investors in technology, sophisticated, experienced. They invested $500 million at $4.5 billion valuation. Did they ask if salespeople were licensed? If yes, Conrad lied. They didn't verify. If no, they failed basic due diligence. Either way, systemic failure. Pension funds invest in venture capital. Your retirement savings, through pension fund managers, partially invested in private tech companies. When those companies break laws and valuations crash, your retirement affected. Not huge impact per person, but across millions of retirees, billions in value lost. Same pattern. Theranos, pension funds invested, company fraud, value to 0. FTX, pension funds invested, fraud uncovered, $32 billion lost. Zenefits, pension funds invested. Compliance fraud, $1.5 billion valuation lost. Who watches Watchmen when Watchmen friends with entrepreneurs? Until pension fund managers held accountable for due diligence failures, pattern repeats. Your retirement savings financing, rule breakers. Lesson 3. Whistleblowers get punished. Until they don't remember Zenefits compliance officer in 2014 warned Conrad about unlicensed selling, documented violations, recommended fixes. Conrad ignored. Officer quit. If Conrad listened, scandal avoided. Company continues growing. Officer keeps job. Instead, officer blacklisted. Hard to find next job. Industry sees them as troublemaker. But 2 years later, scandal breaks. Officer was right. Tragedy? By then, too late. Billions lost, careers destroyed, trust damaged. This repeats constantly. Enron. Sharon Watkins warned executives 2001. Ignored. Company collapsed months later. 2008, crisis. Multiple analysts warned about subprime mortgages. Dismissed. Crisis happened anyway. Theranos. Multiple employees reported fake test results. Fired. Fraud continued years. Whistleblowers punished in short term. Vindicated in long term. But vindication doesn't pay bills or restore reputation. System discourages speaking up. Rewards staying quiet. Until that changes, scandals continue. This pattern isn't finished. Right now, 2025, multiple tech companies operating in regulated industries with questionable compliance, health tech startups doing telemedicine without proper medical oversight, fintech companies offering banking services without banking licenses, real estate tech platforms, brokering deals without licensed agents, Stage 2 evidence, rapid expansion into states without proper licensing, Stage 3 evidence, employee reviews mentioning compliance issues and our regulatory concerns. If pattern holds, and it always does, we'll see another major compliance scandal by 2026, 2027. Watch for tech companies in heavily regulated industries growing 100% plus annually. Job postings for compliance officers with startup environment emphasis. State regulatory enforcement actions. Small ones now, large ones coming. Zenefits, warnings 2014. Collapse 2016. Gap, 2 years. Theranos, warnings 2015. Charges 2018. Gap, 3 years. Next case, warnings showing now in health tech and fintech. Collapse, 2026, 2027. Pattern says yes. I'm watching health tech companies offering prescription services through apps, many operating without proper medical licenses or pharmacy oversight. State medical boards starting investigations. Small fines now. If pattern holds, major scandal coming. You should watch too, especially if using telemedicine apps or online pharmacy services. Here's uncomfortable truth. Culture that enabled Zenefits hasn't changed. Move fast and break things. Still celebrated in Silicon Valley. Venture capital still rewards growth over compliance. Entrepreneurs still believe rules don't apply to innovation. Pattern says this will happen again. Different company, different industry, same playbook. Because incentives creating these scandals, raise money fast, grow at any cost, ignore regulations until caught, those incentives still in place. February 8th, 2016, 9:15 a.m. Parker Conrad signs resignation letter, walks out of Zenefits headquarters. Car waiting. Driver takes him home. Behind him, 1,600 employees processing news. Founder gone, company uncertain, jobs at risk. Outside building San Francisco, life continues. Commuters heading to work, streetcars passing, coffee shops full, just another Monday morning. Conrad's parents told him growing up, work hard, build something meaningful, follow the rules. He listened to first two, built something remarkable, $0 to $4.5 billion in 3 years, fastest growing software company in history, but forgot the third. Decided rules were obstacles, licensing laws outdated, compliance slowed growth, so he built the macro, circumvented training, let unlicensed people sell insurance to 200,000 American families. And an end? Forced resignation, company valuation cut, reputation damaged. But here's what nobody discusses. Conrad kept 150 of them, 200 million, started new company, built it properly this time, now worth $13 billion. Employees fired, struggled to find work, blacklisted from insurance, families with insurance sold by unlicensed brokers. Never knew. Trusted system. System failed them. Pattern complete. But system that enabled it, still there. Tech culture still celebrates rapid growth. Investors still fund companies with compliance problems. Regulators still underfunded and overwhelmed. Next, Parker Conrad, already raising money. Next, Zenefits, already hiring. Different name, different industry, same playbook. What to watch? I'll be tracking health tech and fintech compliance enforcement. Specifically, state medical board actions and FinCEN investigations. If we see 3 major state enforcement actions in the next 6 months, confirms a pattern entering stage 3. History says tech compliance scandals happen every 3 to 5 years in the United States. Been 9 years since Zenefits. Been 6 years since Theranos charges. Due for another. Do the math. Because it will happen. Always does.